Dividend investing is one of the smartest and most reliable ways investors use to earn steady, consistent income while building long-term wealth. Some Nigerian stocks can pay you every single year, even when prices don't move. And the best part, it doesn't require you doing any hard work once your money is invested. But here's the truth most people won't tell you. Most investors are doing dividend investing the wrong way. So today, I'm breaking down a simple but powerful dividend investing strategy for the Nigerian stock market, including insider tips I genuinely wish someone explained to me when I first started. These are the same tips smart investors use to earn steady cash flow, beat inflation, and grow wealth long term in Nigeria. So, if you want steady passive income in Nigeria, make sure you stick around till the end of this video. If you're new here, you're welcome. My name is Rikia, and on this channel, I share trading and investment tips, strategies, and market insights that help Nigerians build wealth in financial markets. If that sounds like something you'd enjoy, don't forget to subscribe and turn on the notification bell so you don't miss any new videos. So, without further ado, let's dive in. Here's a quick reminder this content is strictly educational. It is not financial advice, and you should always do your own research. Dividend investing simply means buying shares of companies that pay you part of their profits, known as dividends. Think of it like this you own a piece of the company, so it's like you owning a small business. The company shares profits with you, so you get paid for holding shares, and you earn money even when the stock prices are flat. Let's make this practical. So, for example, if you buy 10,000 units of Zenith Bank shares and the company declares 10 naira dividend per share, you will receive 100,000 naira. That is 10,000 shares multiplied by 10 naira, paid straight into your account. There is no selling of shares required. As simple as that. That's how dividend investing works. In Nigeria, dividends are usually paid once or twice a year, and the money is paid directly into your CSCS linked bank account. To invest in the Nigerian Stock Exchange, you need a CSCS number, which you get when you register with any licensed broker or apps like Bamboo, Trove, or Chaka. I'll leave a link in the description if you want to register with Bamboo. CSCS simply means Central Securities Clearing System. It's the body responsible for clearing, settlement, and record keeping of securities in Nigeria, including equities, bonds, treasury bills, ETFs, and funds. In simple terms, CSCS is the system that tracks your shares and ensures your dividends are paid directly into your bank account. Now, here's the key most people miss. Dividends reinvested added with price growth equals powerful compounding. What this means is when you reinvest your dividends, you buy more shares. More shares mean more dividends. And over time, that snowballs into serious wealth, a powerful compounding, even if you started small. That is how small investments grow into serious wealth. Now, let's look at some reasons why you need dividend investing in Nigeria. Let's be honest, Nigeria has high inflation, so your money loses value over time. There's pressure on the naira, exchange rates and policies affect income. The market is volatile, so prices move unpredictably, and rising cost of living. So relying on salary income alone is risky. Dividend investing works in Nigeria because it generates steady cash flow that can support your income. It reduces pressure to sell your stocks, so you don't need to sell your shares just because prices moved. It helps cushion inflation over time, and it focuses only on strong established companies. That is why banks, consumer goods, and industrial stocks dominate dividend payouts on the NGX. But here's the thing, not every dividend stock is a good stock, and that's where strategy comes in. Before we get into the strategy, let's quickly talk about mistakes. Most Nigerian investors chase the highest dividend yield. High yield doesn't always mean safe. This is often a dividend trap. A company paying out too much of its profit as dividends may have little left for growth, and that's risky long term. Another one is they buy just because they paid last year. Dividends are not guaranteed. Companies can cut or stop dividends anytime due to financial issues. Also, ignoring company fundamentals. Weak companies lose both price and dividends. Poor earnings, high debt, and poor cash flow can wipe out both your dividends and your capital. And lastly, buying after dividends are announced. Buying after announcements means that by then, smart money has already entered, and this is how many investors lose money. So let me show you the right framework. So step 1 is to look for companies that have paid dividends consistently for many years. You can search online for this information by typing the company name and dividend history all together. So let's say you want to check the dividend history for Jitco or Dangote Cement. You simply search for Dangote Cement's dividend history on Google. And if you click on the company's site link, this one right here, it will take you to the page where you will see a record of all the dividend payments to date listed. Don't focus on only the current dividend. Look for companies that have paid dividends consistently over many years, survived market downturns, and maintained stable cash flow. Companies that have survived downturns and maintain stable cash flow are safer and more reliable. Examples of companies Nigerians are familiar with include Jitco, Zenith Bank, UBA, Dangote Cement, MTN, and similar names with long dividend history. If a company skips dividends during hard times, that's a red flag. Step 2 is looking for companies with sustainable dividend yield. Dividend yield tells you how much dividend payment you will earn relative to the share price. It is calculated as dividend per share divided by the share price multiplied by 100. So if a stock price is 150 naira, for example, and pays 12 naira dividend, the yield is 8%. That's 12 divided by 150 multiplied by 100. But remember that high yield doesn't always mean it's good. If a stock price crashes, the yield may look high, but the company could be in trouble. A high yield with weak earnings is a dividend trap. So it's best to focus on moderate yields backed by strong earnings and growth potential. Step 3 is looking for companies with strong earnings and cash flow. Dividends come from profits, not promises. So always check the company's revenue trend, their profit margins, their debt levels, and their operating cash flow. A healthy company should earn enough to pay dividends, reinvest for expansion, pay down debt, and survive tough periods. If profits are falling but dividends are rising, that's a warning sign screaming, be careful. You can also look at the dividend payout ratio, which is calculated as the total dividend paid divided by the net income multiplied by 100. This tells you how much of the company's earnings are paid out as dividends. An extremely high payout ratio is not sustainable long term. And step 4 is all about timing. This is making sure you buy before the crowd. Here's what smart investors do. They buy months before dividend announcements, during market pullbacks, or when sentiment is low, and they rebalance or take profit after qualification dates or after price run-ups. This helps you avoid buying at the top when the price is already high. Understanding and knowing important dividend dates is very crucial for implementing your strategy. There are 4 key dates you must know. 1 is the declaration date. This is the date dividend is declared publicly. The second one is the ex-dividend date, also known as qualification date. You must own shares by this date. The third one is the record date. This is the cutoff date for companies to determine shareholders that are eligible for dividend. And the fourth one is the payment date. This is when the dividend payment hits your account. If you miss the qualification date, you won't receive any dividend. Now let's talk about dividend reinvestment strategy. This is where real wealth is built, and this is how it works. Instead of spending dividends, you reinvest it into quality stocks. You buy more shares during dips, and then it compounds over time. Each dividend buys more shares, and those shares generate more dividends. This is how dividends quietly grow your income year after year, and that's how small portfolios grow big. Also, remember to always diversify across sectors like banking, telecoms, manufacturing, consumer goods, and agriculture to reduce risk. Reinvesting dividends beats time in the market long term. Okay, so dividend investing is powerful, but it's not risk free. And this is where many investors get it wrong. So here are risks to watch out for. Watch out for first, regulatory changes. In Nigeria, new banking rules, taxes, or sector regulations can reduce company profits overnight. When profits drop, dividends are usually the first thing to be cut. Second, falling profits. Dividends are paid from earnings, not promises. If a company's profits are declining while dividends remain high, that's a red flag and often unsustainable. Third, excessive debt. Companies with heavy debt must prioritize loan repayments and interest expenses before paying shareholders. In tough economic times, dividends can quickly disappear. And finally, one-off special dividends. This may look attractive, but they're not recurring income, so you won't get it regularly. Smart investors don't mistake one-time payouts for long-term dividend strength. So the key takeaway here is to think long-term. Focus on sustainable profits, manageable debt, and consistent dividend history. Always think long-term sustainability, not quick cash. So dividend investing in Nigeria works if done correctly. If you just focus on strong companies, sustainable dividends, smart timing, and long-term compounding, you don't need millions to start. Just start small, be consistent, reinvest your dividends, and stay patient. Passive income is built, not rushed. In my next video, I'll show you my personal dividend strategy for earning passive income while growing my portfolio. So make sure you subscribe and turn on notifications. And if you want a future video where I break down the best dividend stocks in the Nigerian stock market, like this video and comment dividends below. See you in the next one.